Hello everyone. Welcome to welcome to today's episode. On today's show, I want to show you how to analyze balance sheet like a pro. I want to show you how to analyze balance sheet like a CFO. Because how does a CFO analyzes his or her balance sheet? First of all, he or she looks at it from a risk perspective, from a risk angle. But before then, let me introduce myself. To those of you who don't know me, I have 20 years experience as an accountant. I'm a CA qualified, and I've worked in big multinational companies around the world, in the UK and the US, in mainland Europe, in Germany, Netherlands, Belgium, Italy, and you name them all. And I've also been responsible for Asia Pacific. And I've been a finance director, finance international director, tax director, and I've been a finance controller, finance manager. And so that is me in a nutshell. I was an MBA and just rounding up my PhD as well in risk management. But today I want to talk to you guys about how to analyze a balance sheet. Because when you look at the balance sheet, the first thing that should spring to your mind as a CFO or as a CEO is your risks. You want to look at it from the risk perspective. As well, if you're a finance controller or the financial controller or an MD, finance director, if you look at your balance sheet, the first thing you want to look at is what are my exposures? I want to know what are my exposures, and your exposure means your risks in terms of your account payable, account receivables, in terms of your cash, because in finance we say cash is king, and it is true that cash is king, because without cash you won't be able to pay your suppliers. Without cash you'll be able to pay your employees. Without cash, you'll be able to acquire inventories or raw materials to produce your product. And the list goes on and on and on and on. And without cash, you'll be able to pay your regulatory requirements in terms of your taxes when due, or your VAT for those of you who live in Europe or in the UK. Now, without further rambling or whatever, let's dive into our balance sheet. As you can see on the screen, that is a balance sheet. Of course, a balance sheet is at a point in time, and I've prepared this balance sheet just as an example for 5 years in a row, but it's at a point in time. And before we dive into analyzing the balance sheet in front of us, let us first of all define the accounting equation. And that is your asset equals your liability plus your equity. That is your accounting equation. And as you can see here, before I begin to go through the items one by one, as you can see, if you look at this line here, if you look at the line in yellow or in orange, it should be in yellow, you can see the first, as of the year ending 31st of December 2022. Now, for this company as a digital marketing, and for the year ending 31st of December 2022, they have a total asset of $1.1 million. And if you scroll down to their liabilities, to the total equity and liabilities, look at their liabilities. They have a liability. If you look at the total liabilities here, you say, what is the total liabilities? And you say that plus that gives you that. And that is your total liability for the year, 554,000. Now that plus total shareholders equity, that should bring you to that, and that is your total liability and your shareholders equity, and that should equals your asset, which is up here, as you can see. So your asset and your asset equals your shareholders equity plus your liabilities. So your liability and your shareholders equity on one side and your asset on the other side. Both sides must balance. It's that simple accounting equation. Both sides, just like your debit and your credit must balance. Your asset and your liability must balance as well. Okay, so let's look at this company in more detail. Now, as a CFO or as a finance controller or as a finance director, once you pick up your balance sheet, you want to look at your, first of all, before you start a year-to-year comparison, what I do as a finance director or as a finance controller, first now once I pick it up, at the end of the month or at the end of the year, normally if I pick it up at the end of the month, I do month-to-month comparison. Say this month to the past, to the last 3-4 months, and then I do yearly comparison, this month versus last month, versus the same month last year, and versus the same month 2 years ago or 3 years ago. I want to see the movement. I want to see, because you want to understand the trend. You want to understand the risk, your exposures. Okay. Now you want to look at your, first of all, you want to look at your cash and cash equivalent. This is your cash and cash equivalent, which is your current asset, are those things that, for example, your cash in the bank. What are things that are equivalent to your cash that you can easily convert to cash? For example, your receivables. So you want to look at your cash and cash equivalent, and then you want to look at your receivables. And your receivables are coming from your AR, and that is from your customers. What are your outstanding? And then you want to look at your day outstanding. For example, you want to calculate your day pay outstanding, things like that. And you want to dig it deeper to understand what is really outstanding. Which customers are really dragging that are using your revenue. That are using your money to do their own business. So you can collect your money so that you can do your business as well. So you want to run this report from your finance manager. You want to tell your finance manager, please, can you get me your day outstanding, your day pay outstanding, or your receivable outstandings. I want to compare month to month. I want to see those customers so we can hand them over to either credit collection, or we can sell them so that we can, because there are so many companies that you can sell your debt to, and they will pay you in advance. Maybe they pay you 80% of the outstandings, or 90%, or 70%, depending on your arrangement. And they will collect it, and they will pay you that money, and they will go after chasing the guys to collect the money. And so you want to do that, or you want to do it yourself. You want to hire, or you want to begin to push your account receivable team in-house to begin to collect the money from your customers. You want to look at you want to look at 60 days, 30 days, 120 days, 180 days, 360 days, and so on and so forth. Now, and next you want to look at as well, then you want to go into, I'm just talking about the asset now. You want to look at your deferred asset, or your deferred taxes. Some companies may not have this, but every month, if you're a listed company, at least every month, that's what, or before, at the beginning of your financial year, when you're doing your budget and forecasting, you want to also calculate your deferred asset and deferred liabilities. in terms of your taxes, because you want to factor those into your forecast. So you want to know your deferred taxes in terms of the money some government or your government is owing you, or some countries are owing you, so that you can use that as well, so that when you do your annual tax filing, you can pay less tax, or they will pay to you in cash. Some government pays you these tax assets in cash. Some of them offset it on your future liabilities and things like that, So, and then you want to dive into your total current asset, which is here below. And that your long-term non-current asset, which is for example, you start with your PPE, which is property, plant, and equipment, like your machineries, your buildings, computers, and the list goes on and on. And your goodwills, in terms of your brand name, your logos, your staff. These are your goodwills, or your management team. These are your goodwills. And because if you are at one point wants to merge or want to sell your company, these are all calculated. These all have their own values as you calculate the value of your company. So, and then you talk about intangible assets. Intangible assets also includes your brand name, typically your brand or your trademark. Let me put it that way. Intangible asset is your trademark. Intangible asset could be as well your technology, your registered patent, or things like that. And you talk about other assets. Other asset could be, for example, those that are in restaurants. Some of them, like if you look at McDonald's has a lot of big assets in terms of real estate. They rent, they buy a whole building, they renovate it, and they rent it out. Some companies do that. Or you rent a whole building, and part of that building you rent it out to other companies to do their own business. At the end of the month, you collect the rent and you pay the landlord as well. So these are all part of the deal. Or you buy the whole property, the whole building, while you occupy some part of it. The other part of it, you rent it out to other businesses, to other companies, and they pay you rent at the end of the month. These are part of other assets that you own. And then we bring it down. That brings us to total assets. As you can see here, total assets. And this part here, liability, is a place where, as a finance controller and as a finance director and as a CFO, you want to look at this very portion very carefully, because you want to understand your payables. I've worked in organization that at one point we did not understand our payables. Why? Because even though we had an SAP that was back in 2010, and all the invoices, when they come, they're just dumping on the table. We had 2 or 3 account payables back then. Once they receive the invoice, they open the envelope and they just dump it on their desk. There was no first in, first out in terms of payment, or pay at least according to the terms that we have with the supplier. So, and there were a lot of invoices, sometimes 90 days, 120 days, 180 days not paid. To an extent that some suppliers sent us threatening letters and sent us legal threatening letters. So you want to look at for these as a controller, and you want to calculate this on a monthly basis. What are your day outstanding payables? And with different software, this for example with SAP, with Oracle, NetSuite, with Microsoft Dynamics or with Microsoft Business 365, you can run these reports instantly without much hassles. You can just run them like that. You can see it, you can analyze it, put it on a spreadsheet and analyze it, do a pivot table or VLOOKUP, you can analyze it. And then long-term debt, you want to understand what is your long-term debt as well, so that you're able to prepare for those, able to know when they are due, so that you can meet your obligations. And not in addition to that, you want to understand their nature and what they are, because at the end of the year, during the audit, I know as an auditor as well, I'm an auditor, during the year audit, auditors are going to ask you for these, ask you for contracts relating to these, so that they're not just fictitious stuff on your financial statement. They want to verify it, and you must provide, in some cases, if not all the cases, if you cannot explain the item as a senior, or as a finance director, or as a finance controller, or as a CFO, then they want to see the contract so they can verify the liability that is sitting on your balance sheet. Okay, and that brings us with all of that as a current liability. That brings us to our total current and non-current liabilities. And now we'll move on to the last part of your balance sheet, which is your shareholders' equity. Then you have your shares, your preference shares. You have common shares. Common shares are those that the shareholders, or for example, when you register a company with either, say in the UK, Companies House, or with your Chamber of Commerce as a limited company, one of the things is that your common shares is what is the worth of your share of your equity that you deposit in the company, or that you're using to start up the company. So you have your preference shares, you have your common shares, and then you have your return earnings on the shareholders side of the equation. And these common shares are the shareholders fund. Shareholders are the shares that have been attributed to the shareholders. And in addition to that, then you have your return earnings, and that brings you to the total of total shareholders equity. And with your total shareholders equity plus your current and non-current liabilities, both of those amounts should equal your, as it's up here, your assets. And then you want to take it a little bit further as a controller or as a finance director. It's not just looking at a rosy number or at a dismal number at the end of the year or at the end of the month. That may not give you the full picture of the performance of the affairs of the organization. So what you want to do, you want to compare at least prior period to current period, or the same period last year, 2 years ago, 3 years ago, so that you can have a whole picture. Because with that analysis, you'll be able to know, you'll be able to pinpoint what are the issues. You'll be able to know what are your cost drivers and what are your revenue drivers. And you armed with your cost drivers and your revenue drivers, you cannot make an informed decision with regards to your organization and with regards to your balance sheet. And you want to be able to know, say, okay, my asset, my liabilities. I don't know if some of you can see what I have here on my board here. I was trying to lecture some folks a couple of weeks ago about why cash is king. I was talking about cash flow statements and how to analyze cash flow statements, and I was telling them that whether it's your personal finance or whether it's organizational finance, what is important, you want to understand your sales. And after understanding your sales, then you want to understand the value you're creating. And once understanding your value you're creating, and you want to know, can you scale up as a startup? And then you want to understand your income, your expenses, your liabilities, and your cash flow, because cash is king. So, but anyway, that is apart from balance sheet analysis. So, after analyzing a couple of periods, then you're in a better position to make that informed decision to your organization. So, folks, I hope this helps. And if you have any question, just leave me a comment on the comment section below. And if you like the session, I'll be dropping also a video on P&L, cash flow statement. I'll be dropping a video on assets. I'll be dropping on that video on taxes, and the list goes on and on and on and on and on. And so yeah. So on the next time, if you enjoy and like this video, I will appreciate if you can subscribe, share it, and let us help one another. And until next time, keep exploring finance and keep understanding your balance sheet. Take care. Bye-bye.